All right, so I just clicked record. It's 10:35, so we'll start. Once again, good morning. Welcome back. I know we only saw each other briefly, for one meeting, and it's nice to be back on a somewhat regular schedule. Hopefully, you had some time to catch up or relax or do whatever was necessary over the 2 days that we were off last week. This week and moving forward, we're back to normal. I'm just going to share the screen here, and I am recording. So, if you need to go back and check anything, feel free. But as is the custom, I like to just make sure that we go over anything to do with the calendar. So people are reminded about what's happening. Today is the last day to finish your personal biography. It's due on Blackboard by 6 p.m. today. If you don't know what I'm talking about, maybe, it's last week was a lot of information coming at you guys at a fast clip. Yeah, you can see that there's 5 questions that you have to complete, and they have to be completed on the discussions tab over here. And you can see people have already been going at it. So many people seemingly already done, which is great. So there's probably just a few stragglers who should still be catching up to finish that by today. Then the other thing that is also due this week, remember last week we spoke about the textbook and access to Connect. You will need access to Connect. And this, as I discussed last week, this is the link for our class specifically. If you already had purchased the book, it's the 10th edition of the book, it's the same edition as before, and you had Connect access, you should still be able to use that same access code or the same credentials that you had, because the access is normally for a very long period of time. So try to use, your old code to get in, or your old username and password. If you've never purchased Connect Access, like I said last week, you have choices. You can go straight through the McGraw-Hill website and purchase it that way, or you can purchase through the LaGuardia bookstore. The price is obviously, different, but I just, want to reiterate that with McGraw-Hill buying online, you won't have to go anywhere to collect anything. So if you happen to not be in the city, or you can't travel or whatever, you can just get the access immediately. Whereas with a bookstore, you have to either go into the bookstore to pick up the book, which means you have to show your vaccination status and all kinds of stuff to even get onto the campus. Or you can, which, I mean, if you're vaccinated and all of that, it's not a very lengthy thing. I'm just saying that these are the types of things we have to be thinking about in these COVID times, right? You can't just show up at the LaGuardia bookstore to buy something. You have to actually have proof of vaccination or proof of a negative COVID test to get onto campus these days. So, if you're taking all your classes online and you haven't needed to be on campus, that's something to watch out for. I think you can do curbside pickup through the bookstore, meaning that you don't actually have to go inside campus, but you would have to just double check with the bookstore. This price over here is for the loose leaf textbook along with the Connect access. I'm asking that people try to have access by no later than this Wednesday, September the 22nd. I do understand that there may be constraints, whether financial or otherwise, like maybe you did buy from the bookstore, but you can't get there by Wednesday. Nothing bad is going to happen on Wednesday, if you don't have the access yet. I will just remind you that, things start to kind of move quickly after a while, and we'll have homework already due on October the 4th. And I know it doesn't sound that close, but we're already on September the 20th, and September only has 30 days. So basically in 2 weeks time, the first homework will be due, and you don't want to only get Connect access, close to the homework due date and then be battling with questions, with no time to come to office hours or to, email me to ask for help and things like that. Plus, if you haven't used Connect before, you may also just need a little bit of time to get used to the system. So that's why I normally ask for people to get the access relatively early so that we can see if you're having problems getting in, or if you're having problems navigating the system, or if you need any additional support. All right. So on this Wednesday, I'm hoping by the end of Wednesday, most people will have access. If not, again, speak to me, or some people emailed me over the weekend because they were having problems getting in, or at least one person was having problems getting into our section. Remember, this is our URL, so use this if you have had Connect before in 201, or if you're repeating 202 and you used Connect, you would have to use the specific URL for my section so that you don't end up being thrown out of the system. Does anybody have questions about the personal bio that is due 6 o'clock today, or about Connect access?
Good morning, Professor.
Hi, morning. What's up? Oh, do you have a question, or you're just greeting?
No, I don't have question, Professor.
Okay, well, thank you for
How are
greeting.
you, Professor?
I'm okay, I'm keeping it together. I have a 1-year-old who, is not fond of sleeping at night. So I might not be firing on all cylinders, but being with you guys always makes me feel energized. So I'm feeling good. All right.
Professor,
Yeah, go ahead,
I
Marina.
have a question. Yes,
Yeah,
thank
go
you. Good morning. I have a question about textbook.
Mhm.
So once I click the this site to purchase the textbook, which is a Connect Access, it shows cost maybe $19.
Yeah, that's not 19.
No, 90, just
Yeah.
$90.
90. Okay. Can you, so let's do this, Marina. Send me the link of what you are clicking. And when we have a break later, I'll look to see what it is that you're clicking and try to clarify what you are seeing. Okay. Because maybe there's some discount that's happening, but we also want to make sure that you're not buying the wrong thing.
Yeah, I think another classmates has the same situation, happened the same thing.
Okay. Okay.
Yeah,
So then, thank you for bringing this up. Send it to me on my email. You have my email address, right? Or put it in the chat, and then well, if you put it in the chat, people might get confused about what that is. So just send it to my email. I'll look at it, and then I'll try to clarify for you what's happening. Okay.
Yes, I understand. Thank you.
Perfect. Anything else, guys?
The homework is too hard, Professor.
Well, remember, you're trying to do the homework before we've gone through all the work, right? So hopefully, as we continue, things will become clearer, because I'm going to explain all the stuff that will be similar to the homework. Okay. And if you are still stuck, if you have time between 1 and 2 p.m., even today, I have office hours. And if you don't have that time, speak to me about another time that you want to meet up with me. All right.
Okay, Professor, I'll do that.
Okay. So guys, talking about office hours, just a reminder that we do meet, or not, we don't have to meet, but the office hours are Monday, Tuesday, Thursday, 1 to 2 p.m. I should probably put that here. Sorry, it's on the syllabus though. And this is the information to join the office hours. So today, after our class, I'll basically at 1 o'clock, I'll basically be on a Zoom call, most likely by myself, which is fine. But if you want to join and ask questions, you're welcome to join between 1 and 2 anytime. I'm on there from 1 to 2, like at maybe 1:57 or something. I'll decide that no one's going to come or whatever. And then this week, Wednesday, remember we spoke about this, there's also a reg hour for our class on Wednesday from 1 to 2 p.m. So this Wednesday, the class will be happening. This is the Zoom information that Raphael gave me to share with you, where you can join the class. The reg hour does not get recorded to be, you know, put somewhere for later reference. It just happens in real time. So you would have to join and make sure that you are there on time and ready to do the work. I met with Raphael last week to go over you know, the expectations for that class and also the syllabus for the reg hour, which is here on our syllabus page. And I'd gone a little bit over it with you guys before. Remember, it's the e-portfolio class. If you already created an e-portfolio, either in a first year seminar or in the class BTI 121 or something like that, you're basically working, you're just continuing work on the e-portfolio if it's, you know, was created recently. And he will take you through all the steps for that. So again, if you don't know, you don't remember, you know, how to contact people during the Zoom or for the Zoom, whether it be office hours or the reg hour, the information is right here on Zoom meetings info. And then the last thing I'll say that's kind of administrative, well, actually there's one more, sorry. Here's the Zoom notes and examples. So for chapter 8, for instance, the notes that I'm going through are these over here. And then the class examples, I will work through systematically with you on this document over here. So if you'd like to download them while the class is going so that you can have your own reference, because I'm toggling between screens and stuff, and it might, you know, you might not always be able to see the question when I'm working on the answer. Feel free to download these things. You can even print them, do what you will with them. All right, it's really up to you how you want to handle that. Then the last thing I'll say, which is also something I guess that is due this week, is not, the term paper is not due, but you need to decide which company you want to write about. I know it's a lot of stuff, guys, that you have to remember. So, you know, you got to be organized, mark your calendars, write down on a piece of paper, but set alarms or something, because by Wednesday you want to have sorted out your textbook. You also need to tell me which company you want to write about. You also have to attend the reg hour. Okay, so this is almost like if you're in a job, which I'm sure almost all of you are, and you have multiple bits of work to do, you have to multitask and so on. So, you know, you decide which company you want to analyze, and please send me an email immediately if you know what you want to do, because after, it's first come, first serve. So once 4 students have chosen a particular company, that company is closed. No one else can do it. All right, it's 4 maximum. So then it moves on to the next one. So if you know that you want to look at Nike or something, then you gotta make a move and tell me via email which company you want to work on. And okay, so someone's telling me in the chat, but okay, that's fine, Jaron. I'll put you down for Netflix, but please follow up with an email because I won't be able to keep track of the chat if everybody puts their stuff in the chat. Okay, so Jaron, I can see you want to do Netflix, but I'm from here on out, I'm only going to receive names of companies via email. Okay, so that's that. Any questions on anything that I've said so far? Okay, so again, if you're ever confused about something being due, where to go, what to do, you're welcome to review the Blackboard, but you're also most welcome to contact me. If you don't know where my email is, you can find it under the contact tab over here. That's my email address. It's also on the syllabus. Just email me. Don't spin your wheels. Don't spend hours trying to figure something out. If you really can't figure it out, I'm happy to help, you know, resolve whatever the issue may be. Okay, so since it doesn't seem like there are questions at this time, I will go back to what we were talking about last week, which again, this is the chapter 8 notes. And the notes are kind of like a summary of what's happening in the textbook. They're not a substitute, obviously, for reading the textbook, but they do save us some time in the class in that we don't have to, you know, rewrite everything or re-summarize everything. Okay, so chapter 8 and 9 specifically deal with inventory. Last week, you know, and it feels like it was so long ago. You know, last week, Monday, feels like a lifetime ago. So I'll just briefly recap. Chapter 8 is about the initial measurement of inventory. So what do you record inventory at when you purchase it? What can be included? What is excluded? How do we measure inventory in terms of FIFO and LIFO and average cost, things that you might remember from accounting 1. And there's also another methodology that we will cover called a dollar value LIFO. Then we're also thinking about things like, what if there's inventory that's still on a truck somewhere and we have a year end, let's say of December 31, does the inventory belong to us or does it belong to our customer? You know, what should we do about that inventory? And then we also talk about the different methods that companies use to record inventory. So you've heard these words before, the periodic method or the perpetual method. And what does that look like in terms of journal entries? And then ultimately, does it really impact your gross profit if you use one method or the other? So that's chapter 8. Really the initial measurement of inventory. And then chapter 9 has got to do with subsequent measurements. So, you know, when you look at the lower of cost or market value, what if inventory is not as popular as it used to be and we have to write it down? What are other methods that we can use to estimate the cost of inventory? Like, let's say our whole warehouse burns down and we need to make an insurance claim. How do we estimate what was in that warehouse? Things of that nature, right? So the two chapters go together in a way, but chapter 8 is first because the initial measurement is first setting the scene for how to record inventory. And again, we said that inventory obviously is an asset. It's a current asset because we expect to realize the benefits within 1 year from the balance sheet date. That's what makes something current, right? That it's within a year from the balance sheet date, we'll get the future benefits. And we're going to sell it in the normal course of business, and it's not property, plant, and equipment, right? You know, and of course it could be part of manufacturing. There could be raw materials, there could be we went through this last week, raw materials, work in progress or work in process, and finished goods if it's a manufacturer. And there we spoke about some of these car manufacturers like General Motors and others, some of them that have even recently said they've had to drastically cut back on how much inventory they will produce because of the shortage in semiconductor chips in the world. So you have manufacturers and then you also have merchandisers. A typical merchandiser would be like a Target or a Walmart, a CVS, and so on. So those are the two types of, I guess, inventory that we have. I thought it might be interesting for you to see that discussions on inventory are not just something that exists in the textbook. Here's a gentleman in the Wall Street Journal standing in a store. Does anybody recognize what store this may be just by virtue of having shopped in the store or in a store like this before? Yes, Madeline, did you want to tell me?
Oh yes, CVS.
Oh yeah, oh
The
yeah.
tags.
What did you recognize? The
The
label?
yellow tags, yeah.
The yellow tags. Oh yeah, CVS, always a sale, eh? With the invoice, what do you call it? The receipt that looks like the longest piece of paper you've seen in the history of the world. But at CVS, as Madeline says, and this man, Ben Dugan or Duggan, works for CVS. His job is battling a $45 billion crime spree. So who wants to take a guess? Madeline, it can be you or somebody else wants to speak. What do you think this crime spree is relating to? What do you guys think is happening in CVS? Or have you maybe even seen it happening in CVS?
Shoplifting.
Shoplifting, absolutely. In fact, is it Pura? Is that how you say your name? Pura?
My name is Fura, yes.
Fura. So Fura, have you noticed of late that CVS is putting like a lock on a lot more of their inventory? Like you can't.
Yeah, I don't have CVS in my area, but I go to Drenry, Walgreens,
Yeah.
and yeah, they do have like locked items, and
Yeah.
I've seen people shoplift when I was there.
Oh,
They tried to steal lotions and like kids' toys.
Oh
Yeah,
my word. So you saw it in action, right?
yeah,
And that's scary.
yeah.
What did you say? You reported it?
Yeah, I
Mm.
told the employees there that someone's shoplifting.
Yeah, that's all you can do is just tell the people in charge. This definitely should not be approaching the person at all. Yeah, so exactly. I was in a Dwayne Reed on Friday and I was looking at the chocolates and I'm like, oh, this chocolate is interesting. Let me see what's going on with the ingredients. And then I'm like, oh, the whole thing is locked. I can't even get in. And I'm like, is the situation that bad now that chocolates are now also, on lockdown? It used to be like baby formula and other stuff. Now it's like everything. So that was, to your point, that was in Dwayne Reed. So this guy is working for CVS, trying to stop what is basically a crime ring of people coming in, just like Fura was saying, and they're stealing. They're coming in with trash bags and stuff and stealing inventory and then going and selling the inventory on Amazon and other like online, I guess, places to sell stuff online. It seems here that it's about 50 million in products was being stolen by one group in Northern California, but retail theft, he estimates that retail theft accounts for around 45 billion in annual losses for retailers, and that's up, right, 50%. It was 30 billion a decade ago. And so I think, what Fura was saying makes sense to me. The person was trying to steal, lotions and kids' toys and stuff. Now, sorry, I keep doing that. Now that it's so easy to sell things online, people are just randomly getting some items and probably trying to make a buck, by selling them. There's the kind of lockdown situation that you have. Mdadul, am I saying your name right? It looks like you are.
Yeah, funny. That thing happened yesterday. I work in a Duran Walgreens, Australia.
Oh yeah.
So there was a guy who got in and stole the whole headphones. It was locked and everything, but he like dragged it out and it's so hardly it ripped off and everything. He doesn't care if happens something to the box or nothing. He's just gonna sell it. Maybe in the street, maybe in the train station or something like that.
Yeah.
And the lotion, it happens too. And stole the whole lotion, hand sanitizer, and everything else, just like that.
Wow. So
And we can't even do anything about it because if you do like even touch or take a picture or show the or take a picture, I feel like they can like sue or something like that. But, yeah.
Because then it's your word saying, yeah, I understand what you mean. Then you're saying someone stole something and they may have a way to say that they didn't, or they could get rid of the stuff and claim that you're harassing them or something. Wow. So you're seeing it, people are seeing it happening in real time. So
It happening since I started working like every single day. You can't do anything about it. And the worst thing is, like, I see on other Walgreens, they have guards and everything, but the place I work, they don't have there. And like in Astoria, there's like lots of people need stuff. It's close by to their house and everything, and they don't have a guard.
Right. So they probably need to work on beefing up security because of the loss of the inventory. Thank you, Mdadul. And in retail language, they have a very nice sounding name for this kind of loss. They call it shrinkage. But it's basically theft or spoilage or whatever, all those things go into shrinkage. But the question then becomes for those who are like, well, what does this have to do with what we're doing? Well, you can imagine that the ways in which you record and account for your inventory can at times help or hurt your ability to track, to see, what is being stolen and what is still there, and what Mdadul was saying, like, do we have security in place to make sure that these things are not happening, etc., etc. So when we go through talking about periodic and perpetual inventory methods, recording inventory, I'll just talk about it in general, and I'll go back to the notes in a second. But if you will, let's think about what this means. Periodic, it sounds like a period. Like if you think about a period, something that's happening at some type of point in time, right? And when we say periodic accounting for inventory, that means you only update your books periodically, so maybe once a quarter or once a year, to calculate, right, the cost of the goods that were sold. So I'll repeat, when you have a periodic inventory system, you only update your records maybe once a quarter or once a year based on an inventory count to calculate what the cost of all the goods that you sold is. Other than that, you don't have an update to inventory every time you sell something. So, not everything is about theft, obviously. We can't contextualize our entire class, around theft, but it does help to think about it this way. If you were running a store and your only update to your inventory was once a quarter or once a year, if this person, whoever they may be, is walking around here stealing things left and right, and you don't have the security like Mdadul was talking about, or you don't have cameras or whatever, you would only find out really at the end of the period that it seems like you have much less inventory than you expected to have. But because you haven't been updating your records every time there was a sale, it's difficult for you to say whether the number, whether there's a lot of theft in that number or not. You just wouldn't know, because you're just counting everything at the end, and whatever is left is after the sales and after all the thefts and so on. Whereas perpetual, and the word perpetual means ongoing. So when I'm recording inventory on the perpetual method, it means that every time we sell an item of inventory, we update our books to say the inventory has gone down and the cost of goods sold has gone up. So I'll just press pause and remind you that inventory is an asset, right? A current asset, and cost of goods sold is the expense that relates to that asset. When we sell the inventory, we have to recognize the expense cost of goods sold. So when we're on the perpetual method, every time we say, debit accounts receivable, credit sales, or something like that, we also have to update cost of goods sold and inventory. So that then means that on the perpetual method, you are constantly keeping track of your inventory balance. So at the end of the year or the end of the quarter, if you're counting, it's more the end of the year, when you're counting inventory, you will actually then be able to see if what you have in inventory is similar to what you think you should have in inventory. And so after a while, I think companies may start to notice that there's a dramatic difference between the two. That in conjunction with seeing people like Embedor was saying, and Fura and others were saying that they basically are seeing people blatantly stealing things in the store, will make the company realize that they are losing. And this is what this gentleman, Ben Duggan, is talking about, that they're losing up to $45 billion in inventory every year, which is out of control, right? That's a massive loss. So they probably have to beef up their security. So when you go back here, you know, in the notes, we talk about the types of inventory systems over here. And I'll just, you know, go through the, I guess, the theoretical side of things, but it's basically, most of it is what I just said to you, that a perpetual inventory system is continuously tracking the changes in the inventory account. So when you buy inventory, it updates the inventory account. When you sell it, it updates it as well. So anytime you can go into your ledger, look at the inventory balance, and that should be what is, you know, I guess to some extent on hand. And then cost of goods sold is also being updated all the time. So this helps the company to keep track of things. And some of the things that that we need to remember is when we are using a perpetual system, we debit inventory and we don't use the purchases account that will be used in periodic. We debit inventory and we credit inventory for purchases and sales. Freight in, that sounds very complicated, but it's really just talking about shipping costs. So the cost that we pay to get the inventory to the location and condition where it can be used in our business is included in the cost of inventory. All right, so you add that on to the cost. Why? Because the FASB, or the the Financial Accounting Standards Board that makes accounting standards, says that you wouldn't be able to use that asset or to to sell it or whatever if you didn't pay the shipping to get it to your store. So a typical example that that I'm sure you've seen at times when the price of gas goes up and you go to the supermarket, sometimes you start to see that the price of basic items is also increasing. Often that's because the supermarket owners want to keep a certain profit percentage, but they are paying more for the inventory because their shipping or transport costs are going up, because the wholesaler is factoring in higher costs of gas. So then they are passing those costs on to the consumers by increasing the cost of the products that we are buying in the supermarkets. So a lot of times that is because the actual shipping cost has increased. You can even think about it as let's say you buy a textbook and the textbook costs $100, but shipping is $10. So the real cost of the textbook for you is $110, right? And the FASB says that that's how you should look at inventory and other assets as well. We do the same with property, plant, and equipment. And if there are any returns and allowances or discounts, those also go into the inventory account, not two separate accounts. They're contrasting perpetual with periodic. Again, under the periodic system, you don't use the inventory account for the purchases. You actually use an account called purchases. I'll come to that in a moment. And what is purchases, returns, and allowances? This is when we buy something and we realize afterwards that either we don't want it and we send it back, or we wanted it, but something's wrong with it and the company doesn't want it back. I'm sure many of you have gone through this. In fact, I just had a friend speak about this the other day. She bought a mattress from Wayfair, a queen size mattress, waiting for it to be delivered. They delivered a king size mattress. Wayfair does not want to come and collect the mattress because I guess it's too much hassle for them to come, plus it would then be a secondhand mattress, which I'm sure, I guess they were not allowed to sell, even though she never used it. So they gave what amounts to an allowance, which is they're saying, we're not charging you for the mattress, but you also just have to keep the mattress and get rid of it yourself. Whereas a return would have been if she sent the mattress back to them, that would be a return. An allowance, you basically keep the thing, but they give you your money back. And then of course, a purchase discount is, you know, let's say your supplier says, you buy the stuff, if you pay us within 10 days, we'll give you a 2% discount, right? That decreases the cost of your inventory. I've spoken a lot, so any questions up to there? Anybody want to say something? Okay. Okay, end the door, no problem. You can watch the recording. All right, and so I don't see questions here. So cost of goods sold is recorded at the time of each sale. That's what I was saying before, that under perpetual, you update cost of goods sold every time you have a sale, and inventory is also updated. And then you may have a subsidiary ledger. We don't have to go into subsidiary ledgers right now, but there may be one. I'm not gonna test you on something that I, didn't teach you, so don't panic now and think that the first question on the test is gonna be about subsidiary ledgers. It won't be. All right, so that's the perpetual system. And then under periodic, the company only determines the quantity of inventory on hand periodically, example, end of the month, quarter, or year. That's what I said before. All acquisitions of inventory during the year are debited to a purchases account. So you don't use inventory, use an account called purchases. The company then performs the following calculation at the end of the year. We look at what is in the beginning inventory. Where does the beginning inventory come from? Anybody? How can we have beginning inventory? Yes.
A company who
Sorry.
who made everything.
Okay, so they could have made it. Yes. And what about also that the ending inventory from 2020 is the beginning inventory in 2021, right? Does everybody follow that? Last year's ending inventory has to be this year's beginning inventory. Yes or no?
Yes.
Okay, great.
Yeah.
Right. Yesterday's the orange juice that you left in the fridge last night at midnight is the ending orange juice, is the same beginning orange juice at 7 o'clock this morning, right? So that's how inventory works as well, unless someone came in to drink it, but we're not going to go into that. So beginning inventory plus the purchases gives you cost of goods available for sale. Net, that's a word that just snuck in there, but as an important word. Net purchases just means purchases minus any returns or allowances or any discounts, right? So net purchases minus returns or allowances, or discounts, gives you everything that was available to be sold by the company for the year. This is important. This calculation is important because it will help you to calculate cost of goods sold. It will help you to calculate ending inventory. It will help you to understand the logic around the journal entries that we make for the periodic system. So just think about this carefully. What I start with, the inventory I start with, plus everything I purchased, minus anything I returned or any allowances that I got given or any discounts, is everything that was available to be sold, right, for the year. And what's available to be sold minus anything that is left at the end of the year after we did a physical count of inventory is my cost of goods sold. And why do we have to go through this formula? Because in the periodic system, we are not making a journal entry to update inventory every time there's a transaction. So we will have to create this calculation at the end to see what is cost of goods sold, okay? And so they also say that when you're using the periodic system, you won't make any adjustments for the difference between the inventory from the count and the inventory in your books, the balance, because you are not updating the ledger as you go along. So whatever you count at the end of the year under the periodic system is going to take into account all the times when someone came in, like Emdadol said, someone came in and stole their headphones, regardless of how they were breaking things or whatever. It takes all of that into account, but you just don't really know because you're only counting the inventory once. Okay, and here's that word due to inventory shrinkage, right? Shrinkage, again, a nice way of saying theft, spoiling, things of that nature. All companies need to take a physical inventory at least once a year, no matter whether you are using the perpetual or the periodic system. Has anybody on this call ever been involved in an inventory count at your job? Okay, so no one has been involved. Normally, the inventory count happens in off-peak hours, maybe late at night. Sometimes the auditors are coming. Or let me ask you, do you know what an auditor is? Oh, hang on. Sorry, someone's speaking to me on chat and I didn't notice. No, okay. Gian, did you want to tell me what an auditor is? No? Okay. All right. So not a problem. If you've ever heard of KPMG, Deloitte, PwC, or Ernst & Young, those are the big four accounting firms that are often also auditors of the big companies, right? And so auditors are often companies that are appointed by the shareholders or investors. So let's take CVS. So CVS shareholders will appoint an auditor to check and see if the financial statements that the company is producing, so income statement, balance sheet, cash flow statement, and so on, if those numbers are what they are saying, what the company is saying those numbers are supposed to be. And so often when an inventory count is happening, the auditors are actually in the room or on the premises to make sure that the count is happening appropriately and that there's no fraud going on. Because remember, I told you last week that inventory is a massive number on the balance sheet. And unfortunately, inventory is also very susceptible to fraud because it's a number that, if you make the number bigger, you can end up having we'll get into this, but basically if the ending inventory number is increased, that will actually make your cost of goods smaller, which will make your profit bigger and vice versa. So you can do all kinds of manipulation of the balance sheet and the income statement by messing with the inventory number. And over the years, there have been many frauds and many, things that have gone wrong with inventory because of companies knowing that it's a fairly easy way to manipulate the books. All right. So where to from here? We've now heard about the perpetual system and the periodic system. So what we'll do is a series of journal entries to see how those two systems look, against each other. So if you are following with the Zoom materials, the notes and examples that are on Blackboard, I'm just going to start looking at the class examples document, and I'm specifically looking at question 1, periodic versus perpetual entries. And so I'll just give people like a minute to, if you haven't yet situated yourself with this information, to just get it, and then I will literally, do the calculations with you as we go along. So take a moment to get the paper if you want to. Otherwise, you can just follow with me. Okay, so I'm going to start reading the questions along, and again, if you're still looking for it or trying to download it, that's not a problem. You'll be able to catch up. So Shin Company sells one product conveniently, right? So you don't have to worry about different prices of different products as you go through. Presented below is information for January for Shin Company. January 1 inventory, 300 units at $10 each. So this is the beginning inventory, right? We spoke about this just a second ago. I said the inventory that exists at the end of the previous year or the previous month is the beginning inventory for the next month. So December 31, there were 300 units at $10 each, and now at January the 1st, those same 300 units are there. Do we need to make a journal entry to record beginning balances? And this is a trick question. Do we need to make a journal entry to record beginning balances?
Yes.
So that was the trick. The answer is no.
Well,
Let's think about where the balance comes from. Who's speaking? I don't know why the thing's not telling me who's speaking today. Who's speaking?
Jerry, ma'am.
Okay, so where do you think the January 1st there's already a balance there, right? A balance by nature means that the money or the item or whatever already exists, right? Do you agree?
Yeah, so when we write everything, we have to first write
I see what
beginning.
yeah. So that's in the ledger. So you do have to put the beginning balance in the ledger, but you don't have to make a journal entry to record
Oh,
it.
yeah.
Okay, got you. So yes, you are correct that when we create a ledger, we will put the balance in, but when we are doing journal entries, we don't have to worry about this. We can, I mean, I don't want to say we can ignore it. It will come up at some point, but we don't have to make a journal entry for it, okay? So there's other purchases and sales that go through, the month of January. Then it says, Shin uses the FIFO cost flow assumption. Does anybody want to tell us what is FIFO? FIFO.
It's
First
first in, first out.
Yeah.
Yes, thank you. So first in, first out for what? What is first in and what is first out? What are
For
they referring to?
inventory.
Inventory, yeah. So it's saying that the first inventory to be bought is also the first inventory to be sold, right? And then all purchases and sales are on account. That means we won't be using cash. We'll be using accounts receivable for sales. And when it comes to purchases, we won't be using cash payments. We will be using accounts payable. So, I mean, you guys are accounting majors, so you know this already, that you have to read the question so carefully, because in one simple sentence, there's so much additional information that's being given to you about how the journal entry should look. Assume that Shin uses a periodic system. We just heard that periodic means that we only update our records to calculate cost of goods sold at the end of the month or the quarter or the year. So every time we purchase inventory, we're not going to use the inventory account. We would use the purchases account. And when we sell inventory, we make no journal entry related to inventory at all, because we'll calculate cost of goods sold at the end of the month. Prepare, so see, again, you have to know the theory. When they say periodic system, they're not going to explain to you how that looks. You have to remember or memorize what that means. Prepare all necessary journal entries, including the end of the month closing entry. So this is where they're talking about to record cost of goods sold. That's what I just mentioned. A physical count indicates that ending inventory for January is 330 units. So they're saying 330 units because they don't want to tell you what price to use per unit, because they're testing to see if you know what the price of those units will be, since the company is using FIFO. So already, people might be thinking, oh my word, did I forget everything? I don't remember how to do this. This sounds really hard. We'll go step by step, and by the end, everyone should be okay. So what's the first step, right? If you get stuck or you feel overwhelmed by a question, do what you know to do. Get the points that you can get. So if I'm looking at this and I'm like, I don't know what's going on with the 330 units. Oh no, I can sit there for 30 minutes and stare at the 330 units, or I can say, what do I know? I know that on January the 4th, there's a sale and I know how to record that, right? Because I know that the sale is on account. So I'm going to get a clean, right? A clean sheet over here. You guys can either watch me or you can, work along with me. And so we are doing journal entries. So we need a debit column and a credit column. Maybe I should give myself a little bit more space. Okay. All right. So going back, and this is what I meant if if you want to download the question yourself, because I'm going to be toggling between them. So we have a sale of 240 units at $16 each. So the dollar amount of the sale is going to be $3,840, right? But now we need to figure out what accounts to use. Well, if we're selling on account, it's debit accounts receivable and credit sales, right? So we're going to go accounts receivable debit 3840, and the 3840 is coming from, you probably know this already, but I just want to make sure it's 240 units at $16 per unit, right? And the credit is going to be sales. Yeah, I think I probably don't need this extra column. I think I went a little bit overboard here. Otherwise, the names are too far from the numbers. All right, so that's the sale on January the 4th. Questions, anybody? All right. Now, you should maybe have an inclination that you also want to record cost of goods sold because you made a sale, right? But remember, the company, we're making an assumption about the periodic system over here for part A. So that means we don't record cost of goods sold until the end of the month when we make that closing entry for cost of goods sold. So we have to move on to January the 11th and calculate the amount of the purchase and then do the journal entry. The purchase is for 450 units at $12 each. So it's $5,400. And we are not debiting inventory because this is the periodic method. So we're going to debit purchases for 5,400. And you remember the question said that all purchases and sales on account. So because all purchases are on account, we're going to use accounts payable. And that's also for 5,400. Stop me if there is a question or if you don't know what's going on. It's a safe space. If you have questions, you ask them. If you are lost, you say, I'm lost. Don't suffer in silence, guys. Okay, then the next one is another sale. They go like that, right? It's a sale, a purchase, and another sale. So what I'm going to do is throw this out to you. There's no trick here. It's going to be similar to the one that we just did on the 4th of January. I'm going to give you 3 minutes until 11:30 to complete the journal entry for the sale. And then someone who hasn't spoken yet today will just walk us through what they did. So if you were zoned out, come back, wake up, and do the sale journal entry for January the 13th. Okay, one more minute, you may be done. If you're done, you can even go on to the purchase, the next item. I see your hand, Jaren, so I'll take you to walk us through the journal entry as soon as we hit 11:30. All right, Jaren, you wanna talk me through it? January the 13th.
Is accounting receivable and sales revenue,
Yep,
and it should be 6,030. 6,030. Yeah.
300. 6,300. Perfect.
Yeah.
Thank you. Did you do the next one, or do you want me to keep on with you? or-
Yeah. I
Go
do
ahead.
the next one also.
Yeah. So it's
So
very
if-
let me just go back to the question before you. So it's just purchasing 480 units at $14 each. Go for it.
Is purchase
Okay,
And
so I'm gonna get
account-
lazy and do a purchase. Okay,
accounts payable,
yes,
and is 6,720.
perfect. Okay, so do you want to close us out? On with the 27th, did you do that one as well?
Yeah.
Okay,
um,
so I'm gonna just go to the questions. That's again, just a sale, 300 units at $18 each. No, there's no funny business here. Go for it.
It's same thing.
Okay,
13.
so accounts receivable, sales, so it's a little bit repetitive, but it's getting us back into the zone, right, of purchases and sales. What's the number you got there?
So I got here is 5,400.
Mhm. Thank you.
Yes.
Perfect. So now it's everything seems really simple and easy, and that's great. And then of course the periodic method hits us with a little bit of a doozy here at the end, because we actually have to now calculate cost of goods sold, because at no point did we actually record cost of goods sold. That's why it tells us that we have to make this end of the month closing entry. Right? So what ends up happening is that you have to think about all the accounts that are involved in this situation. And when you think about it, you go back to what I was talking about before, right? Remember this whole formula, the beginning inventory plus the purchases minus the ending inventory gives you the cost of goods sold. So I'll talk you through the steps of what we have to do at the end over here. The first thing, this is the way to build the journal entry. Okay, so it's kind of like I guess it feels logical, right? So one, you're going to record ending inventory, right? You're going to come up with some ending inventory amount, obviously as a debit, because you want it to be on the books for the next period. Two, you have to record, I'm dealing with the debits first. You have to record cost of goods sold also as a debit, but please note that this number will be solved for. Okay, so it's what we sometimes call a plug number, right? We don't know what it is yet. So we're going to leave the cell blank. The third step is that we need to eliminate purchases. Okay, so we will have to credit, sorry, that was horrible, credit the purchases account. So all the purchases get removed and get split between ending inventory and cost of goods sold, all right? And number four is we have to eliminate the beginning inventory that would have been on the books before because it's now being replaced by the ending inventory. So for the, again, if you were not paying attention to what I'm writing about, this is the closing entry to record cost of goods sold, all right? That's what we're trying to do here. And if you follow these steps, you'll be fine. So we know we need to debit inventory. I don't know what the number is, doesn't matter. I'm just building everything. Cost of goods sold is also a debit. Purchases is a credit. And then there's another inventory credit. So now you might be like, whoa, Professor, why are you doing inventory twice, right? Remember, it's easier here for us to just eliminate the beginning inventory number. So I'm going to put BG to show that that's the beginning inventory number and just record the ending inventory number instead of trying to figure out what's the difference between those two numbers and only record the difference between them. You're actually giving yourself extra work. So don't do that. Just record the total ending inventory and eliminate the total beginning inventory. What do I know, right? Because I'm stuck. It's hard. This is hard work. What do I know? Or maybe it's not hard for you. I'll make it hard for me, right? I do know that beginning inventory was 300 units at $10 each. They told me that before. So I know that what I need to eliminate for beginning inventory is 300 times 10. So $3,000 is the number for beginning inventory. Okay, everyone still with me?
Yeah.
Okay. What else do I know? Again, when the problems seem really involved, think just about what is known. I know the purchaser's number because I've been recording it all along, right? You guys, Jaron and others, you just gave me these numbers. So I know that the purchaser's number is over here and over here, right? I've got some purchases. Was it only the two? I think so. Yeah, only two purchases in this example. So what I'll do is I'm going to add up those two purchases number. The 5,400 and the 6,720 is going to give me 12,120. So I'll put it over here so you guys know where this number came from. 5,400 plus 6,720. So, oops. So I know that. So I've already built out the credits for my journal entry. And even if I stop there, I'd get some points on a test or whatever, right? I don't know what the cost of goods sold number is because that's the whole point of this journal entry. We're trying to find it, okay? And at the moment, I'm a little bit confused about what the ending inventory is. So now I go back to the question and I'm seeing that it says that there were 330 units of inventory left, right, at the end of the year. Now the question is, the 330 units, does it come from the beginning, right, of the month or from the end of the month? And you can't just take a wild guess. You have to look at what they told you. The first thing in is the first thing out. So under FIFO, and we'll go deeper into FIFO and LIFO later on in the class. So under FIFO, that means that the beginning inventory and these early purchases, those were the items that have already been sold because they were the first in, so they are also the first out or sold, right? So the 330 units that I'm looking for really should be coming from the latest purchase. This is critical information, and I want to make sure that everybody's with me. Under FIFO, the first thing to be bought is the first thing to be sold, right? So these units would be assumed to be sold first. If I'm looking for ending inventory under FIFO, the ending inventory is always the latest units because those are the ones that have not yet been sold. So I can actually calculate that the 330 units must be from the $14 each. Does anybody have a question or need me to repeat that? Because this is going to come up again and again in our work. You have to understand how FIFO and LIFO work, and we'll actually spend more time on it in future.
Professor, can you repeat again? I'm sorry, can you repeat again,
That's fine.
please?
Yeah. So first thing bought is the first thing sold, right? That's what they mean by in and out. First thing in is the first thing bought is the first thing sold. So look how many units you sold. 240 units sold. these 240 units came out of this 300, right? 240 of those units were sold. Are you with me?
Yes, Professor.
That leaves 60 units behind. The 60 plus this extra 450, that's what's left behind, 510. So then when we sell another 360 units, that 360 units is coming from the earliest purchases, because the first thing to be purchased is the first thing to be sold. So the 360 units and the 240 units together make up 600 units. And those 600 units will be coming from year
300.
and year. And then you have another sale over here, another 300 units. So let's see how many units were sold in total. It's 240 plus 360 is 600, plus another 300 is 900, right? So you sold 300, another 450, that's 750. So you still need more. So out of here, you would have sold 150 and there will be 330 left over. Do I need to do it on a spreadsheet? Because I feel, okay, okay. And for those who are might be rolling their eyes and be like, yeah, it's 330. If I do the spreadsheet now, it's helping us because later on we have to do FIFO, LIFO calculations. So whether we're doing it now or later, it doesn't matter because we need to see it anyway. Okay, so I'm gonna copy the units quickly. So let me see what's easier. So the beginning inventory is 300, right? At $10 a unit. Then this is what I'm gonna do. I'm just gonna include purchases here. So it's 450 at 12. And that was from oops, what just happened? Yeah, that was from 111. This is from 11. Okay, then you've got 120. There's another purchase. And that's 480 at $14, right? And now come the sales. On 1/4, you have a sale. So I'm splitting it because it's just easier to show how this works. 240 at 16. On 113, you have a sale. 360 at 1750. The dollar amounts for the sales are somewhat irrelevant when you're talking about calculating ending inventory, but I'm just maintaining the information so we have it all here so you can see how everything gets used. Then you got 300 at 18. Now the first question is, what is the total amount of sales, right? 900. That's what I was talking about. Do you see that 900 units total was sold? Yeah. Darren?
Yes,
Mhm.
yes, Professor.
Okay. Okay, thanks. I just need feedback from you so I can make sure that I'm answering your question properly. So as it relates to what was on hand, right? Remember beginning inventory plus purchases, there was 1,230 units, right? That were available to be sold and 900 were sold. So if you say what is in the ending inventory, right? I'm saying what was available to be sold is 1,230 minus what was actually sold. So there's 330 left. You with me? And that's what the question said, that 330 is left. We good?
Yes, Professor.
But we don't know which 330 was left because we're assuming FIFO. So when you're assuming FIFO, the 240 that was sold over here came out of this 300, right? Okay, because the first thing to be bought is the first thing to be sold. So out of 300, I sold 240, leaving 60 behind. Let me see what would be a good way to split this. So the beginning inventory On 1/4, you sold 240, right? And then on, I don't know if this is the best way to do it, but we'll see. And then on 113, you sold another 60. So the beginning inventory is finished. Do you see that?
Yeah.
Okay, and then the purchase from 111. The purchase from 111 on 113, you only sold. So 60 was coming out of the previous one. You sold 300, okay? Because the sale is 360, but you only sold 300 because the other 60 came from the beginning inventory. That's a hard one, but because you're splitting the sale between two batches of inventory. Do you see that?
Yes, Professor. So the 60
It's coming,
is coming for sale.
from beginning
30.
inventory. Yeah, because you're saying I sold 240 on this day, so there's the 240. On this day, I sold 360. So 60 must come from the 300, and the other 300 is coming from the purchase that is 450.
Okay, understand, Professor. Thank you.
Yeah. So, but then you got to keep working, right? You got to keep working the numbers through, because there's still 150 left, right, from this, and that's used on January the 27th. You sold the 150, right? And then the purchase from this one from January the 20th. On January the 27th, you also sold 150. So the purchase from the 27th is 480 units. You sold 150. So the 330 that's left must be from this batch.
So, Professor, we calculate 330 equal to 14.
330 at 14, yeah. And the shortcut, if you want to call it that, to remember this, is that when you're using FIFO, the ending inventory is always coming from the latest date units. So do you see how it's coming from the 20th? The ending inventory is always coming from the latest date units when you use FIFO, not from the early dates, because they've already been sold. All right, so that then means that our ending inventory, to get back to the point here, is 330 at 14, so it's 4620, right? So now we can solve for cost of goods sold. And the way we do that is we just add up everything that is on the credit side, we subtract ending inventory. So basically you're saying beginning inventory plus purchases minus ending inventory gives us cost of goods sold of 10,500. We could have calculated it using this approach as well, but that's not the purpose of this exercise. So now that everybody's head is spinning, does anybody have any more questions about how to calculate cost of goods sold under FIFO? Yes. No? Okay. Will we see this again? Yes, there's a whole segment of the chapter dedicated to LIFO and FIFO. So this is only a primer to get you thinking about it again. And we will spend even more time solving for LIFO and FIFO. We need to break, but I just want to at least finish the gross profit calculation. It's not, it's quick. It's not going to be hard. Does anybody remember how we calculate gross profit? What goes into that calculation? Any takers for gross profit?
Sales minus cost of goods sold.
exactly. So the second part of the question said calculate gross profit. So I'm gonna say sales less cost of goods sold gives me gross profit. We already know what the cost of goods sold is because we just calculated it over here. It's 10,500. The sales, how do we get that number?
Add the all sales.
You're gonna have to go back, right? And
900?
yeah, okay, thank you. So add up all the sales. 15, so where did this come from? It was the 3840 plus the 6300 of sales plus the 5400. So there were 3 rounds of sales, and say sales minus cost of goods sold, that gives you a gross profit. So now the question might be, why did we even do that? What does that prove? It's not going to be as meaningful now. The question actually asks you to do this because, you know, spoiler alert, when we go and do perpetual journal entries and we calculate gross profit under the perpetual method, we will find that the gross profit under periodic and perpetual is, as expected, exactly the same. Okay, so you cannot change your sales number or your gross profit number by, you know, either using perpetual or periodic. That's not the point. It's just how often you update your books. So let's take 10 minutes here until noon, 12 p.m. And I'm here if people want to ask me questions during the break. I'm right here, but take a break. Let's put in again. All right, let's get back to the question. So it just says assume Shin uses a perpetual system. So prepare all the necessary journal entries. So here's where we see that because it's a perpetual system, we will use the inventory account and not the purchases account. We will also update inventory for every purchase and every sale, meaning that after these sales, we have to actually calculate which inventory is being sold. And for Jaron and others who were confused, well, maybe not confused, but we're just asking, you know, how did we get to the 330 units that it had to be $14? When we go through the perpetual journal entries now, I think it will become even more obvious where the 330 at 14 is coming from. All right. So let's go with, I'm done with this. Okay, let's go with the perpetual system. So this is part C, right? And let me put the debits and credits in the lined up properly with where they were before. Okay. All right. Okay, so there's going to be some repetition here. So I'll move quickly through the journal entry that's a repeat, and then a little bit slower through the one that's not. So the sale itself is going to be repetitive because it's accounts receivable, right? And sales. I don't want to say, oh, you know, see above, because then people might get confused and not know what I'm referring to. So I am repeating what we saw before, but now because it is perpetual, you will have debit cost of goods sold, and credit inventory as the second journal entry in the sale. So now we come to what I was discussing with you guys earlier up here, where I said, hey, you know, the 240 units that are sold came from the beginning inventory. So let's see how that works. This cost of goods sold for the 240 units, going back, where am I getting 240? It's 240 units. It's going to be at $10 each because that's the inventory that we, you know, that's the first inventory that we have. So 240 at 10 is 2,400. And so cost of goods sold goes up on the debit side by 2,400. It's an expense, and inventory goes down. And that 2,400 or the 240 units came out of the beginning inventory because that was the first thing in. So now it's also the first thing out. Questions on that? Because if you get that, then you should be kind of okay as we move along. Any questions on where this came from or why we're even doing this? Okay.
Um,
Go ahead.
No, no, perfect. Okay.
You're good? All right. So, and if there are questions and you don't feel like asking or you feel like it's going to take too much time, remember 1 p.m. I'm all yours on Zoom. If you want to come to office hours or otherwise, just email me. I can also just write back and answer if you still have questions. So the purchase on the 11th, there's really nothing, no big deal there, except that instead of debiting purchases, you debit inventory, right? You debit inventory and you credit accounts payable.
Professor, sorry to interrupt.
no
Someone
worries.
writes something in chat.
Oh, thanks. What's up? Can you repeat? I just got back. From where should I start, Jonathan? From the cost of goods sold? Can you talk to me? Or was it you who said your sound was broken last week? Okay. So I'll just go briefly here and you know, I don't want to take too much time. So basically we're in perpetual mode now. For part C, we're answering the question saying what's the journal entry if the company is using the perpetual method. The sale journal entry, the first part is exactly the same. You debit accounts receivable, you credit sales with a 3840. If you go back up, you'll see that it's the same journal entry, except that now under perpetual, we have to record cost of goods sold because we update our records every time inventory is bought or sold. The question was then, well, which units, right? If you're telling me that 240 units were sold, which units are they? Well, they can only be the units that cost $10 because those are the only units that are available to be sold, right? So the classic journal entry for the cost of goods sold, debit cost of goods sold, credit inventory using the 240 units at $10 each. Okay, so 2,400 is where that came from. That's all you missed. Are you okay? And you and maybe the other 2 or 3 people who had the same question and didn't want to ask, right? Okay. Let me see what you're telling me. Yes, thank you. Okay. Oops. You know, I'm forever having a problem with this computer because I'm not actually using my regular laptop when I teach the class. So 5,400 is what we paid for the inventory that it's the same as before, right? Except that we're using the inventory account instead of before we used purchases. Okay, there's the difference between periodic and perpetual. We're now debiting the inventory account, but everything else is the same. It's the same amount. It's still accounts payable. January the 13th, another sale. So again, here you are debiting accounts receivable. And so I'm now even abbreviating that, right? Accounts receivable. And the amount is the same as before, 6,300. And I am crediting sales. That's not the hard part. We know how to do that. The hard part is what do we use for cost of goods sold and inventory? Oops, inventory, right? How do we calculate that? And again, this is practice for when we have to do the cost flow assumptions anyway. You start by asking how many units were sold. Oh, yeah, I have a typo. And I guess no one wanted to tell me that I have a typo. You start by asking how many units were sold. If we go back to the question, we see that it's 360 units, okay? 360 units. We know that 240 units were already sold from the first batch. So only 60 units could be left from January the 1st, okay? So I'm gonna do a little calculation. Sorry, someone looking for me here? Okay, you're saying 4,200. Let me check my numbers. I can't remember. You're correct, Jonathan. But let me take it step by step, okay? So how do we do the cost of goods sold from January the 1st? You've got 60 units at 10, right? And then from January the 11th, you need another, because it was 360 units that were sold, you need another 300 units. And those January 11 units were at $12 each. Okay, we're working with the cost, not the sales price. So I should have just pressed enter. So 3,600 and 600, and that was Jonathan's point that the answer should be 4,200. So we have to split this cost of goods sold between items that were left over from January the 1st and items that were purchased on January the 11th to get to a cost of goods sold of 4,200. And this is how that number is made up. If you're confused about what happened versus what happened here, this was all January the 1st, 240 at 10. And together, these two numbers make up the 300 total units from January the 1st. Anything else that someone needs to ask me about this? Okay, you can still ask in the chat if you want to. January the 20th, another purchase. So this is plain sailing, right? You just debit inventory, you just credit accounts payable. I'm getting a little bit loosey-goosey now with my typing, and it is 6720. It's just the number of units times the cost per unit, exactly the same number as before, but we just use, thank you, we just use inventory as the debit instead of purchases. Okay, that's January the 20th. Then the 27th is the last sale, so 127. So again, the actual accounts receivable and sales piece is kind of easy because they give you the amount, right? 300 units at $18 each. So that's going to be 5,400, right? That's given in the question. The trickiness is with what is cost of goods sold. So we have to ask ourselves almost what is left. On January the 11th, we had purchased 450 units, of which 300 were already sold, right? So it's probably even easier if we put sold over here so we know what happened. Those were sold. That must then mean that for this batch of sales, there's still something from January the 11th, 150 units at $12, right? And then we also have something from January the 20th. How many units? Well, we got to look back and say, okay, we sold 300 units, so it's another 150. 150, and at what price? The price that we paid on January the 20th. What price was that? $14. All right. So 150 at 14. That is what was sold. So we can just do a quick calculation here. And it's 3,900. Let me check my work against Jonathan. 39, or Jaron, sorry, I thought it was Jonathan. Jaron, 3,900. So there's your 3,900. How was it calculated? Half of the units came from the January the 11th batch of inventory, and the other half came from January the 20th. So now that you can see that January 11, those have all been sold, right? The first, those have all been sold. So it's only the 20th that still has stuff left. And the 20th, we bought 480 total, 150 was sold. So it must mean that what's left, right, is 330 units. Oops, units from contact now, sorry, from January the 20th at $14 per unit. That's our leftover inventory. Do we care? not for the purposes of these calculations, because we've already calculated cost of goods sold, but you can see that it's the same, we end on the same place, right? Like we did when the people were using periodic. The perpetual has the same ending number of units at the same price. So it can't be that because the company is using perpetual now, suddenly the number of units left will be different or the dollar amount will be different. It's just not the case. Okay, it will always be the same. And so the D part is asking us again, please calculate gross profit now under the perpetual method. So you guys already told me gross profit is sales less cost of goods sold gives me gross profit. So, oops. So in this case, we can almost guess that the sales will be the same, right? Because the journal entries were the same, but I'll still go through and just add up all the sales numbers. So 3840 plus 6300 plus 5400, yeah, is 15540. That's the same as under periodic. And then, oh, sorry. And then the cost of goods sold, instead of calculating it through that ending inventory, journal entry or closing journal entry that we did, we will just go through and add up the cost of goods sold as calculated after every transaction, after every sale. So it's that, and then that. And so it's 10,500. And so sales minus cost of goods sold gives you 5040. That number should look familiar, and I'll come right back. Don't panic, but I just want to show you it's the same number under periodic and perpetual. So what was the point? The question is trying to obviously have you work out journal entries under periodic and perpetual to make sure you understand which accounts are used, why they're used, and so on. But it's also trying to show you that using periodic or perpetual does not have an impact on gross profit. Like it's not going to change your gross profit because you chose to use perpetual instead of periodic. Whether you use IFO or FIFO would change your gross profit, but not the inventory measurement system. Because if that was the case, then people would obviously just flock to whatever makes their gross profit as high as possible. All right. So questions? I see something in the chat. Oops. Where did you get 150 from? Oh, yeah. Okay. Right. Do you mean the 150 over here? Is this someone who can speak?
Yes, from there.
Yeah, so sure. So if you look at 127, the number of units sold is 300. Okay. So you have to think of two things in tandem. One is previously we had sold, right, these units, of which 300 came from the January 11 batch. Do you agree?
Yes.
So if you look at the January 11 batch, the total batch was 450. So if 300 was sold from that batch, that meant that only 150 was left to be sold. And since we're doing first in, first out, we'll sell that 150 batch, or the remaining 150 first. But that 150 is not enough because we know that we're actually selling 300 units. So we need another 150 units to get to 300. And so what we have to do is take 150 from the January 20th batch to get up to 300 units sold.
Okay, I understand. Thank you so much.
Are you sure? Because
Yes, I understand. That was very helpful. Thank you.
Yeah, so the problem here, and the reason I'm spending time on this, guys, is because we're going to get into FIFO LIFO anyway. The problem here is that you have to think about what is being sold and the inventory that you have on hand at the same time, right? So you always want to, when you're calculating, for your cost of goods sold, you're always trying to get to the number that is equal to, right, what the question said, so many units were sold. It was 300 over here, it was 360 over here, it was 240. And sometimes you have to take from multiple batches of purchases or beginning inventory or whatever to get to your number. Okay, other questions? Yeah. Fine. So again, if you think of something, just email me or, interrupt me or whatever. Let's just move away from this for a second and talk a little bit. We're changing gears now, talking about we're done with the journal entries. Let me say that for periodic and perpetual, and talk about what is included in inventory. When we say in inventory, we mean in ending inventory at the end of the year. The company has to calculate that number to put it onto the balance sheet. All right, that's really the main thrust of the work that we are doing. We are trying to see what's the number for the balance sheet. And when we're doing that, obviously, like think about that CVS example, right? Part of getting to that number is actually counting the inventory that we have in the stores, at the warehouse, wherever there may be inventory for CVS, right? So we're saying the physical goods that would be included at the warehouse, at the store. But what about the things that are on a truck somewhere on the Van Wyck Expressway? What about things that have been consigned, as we call it? Like what if CVS sent some of their inventory to another pharmacy and that pharmacy had to try to sell it on their behalf, or they sent it to Target, or someone they consigned it to another company? Who does that belong to, right? What if there are other types of agreements where things aren't fully sold, but it's kind of, some type of in-between situation. So we're going to look at some examples, but mostly focusing on goods in transit, which means, inventory that is on a truck or on a boat or wherever, somewhere in the world, and the year is ending. So a few things again to remember: situate yourself. You're the accountant of the company for the most part. Maybe you're the auditor. The questions sometimes say you're the auditor. You are looking at inventory at the end of a period, whether it's a quarter or a year or a month. You are trying to see whether the number is correct, whether the company included what they were supposed to include, or whether they included things that they should not have included. And in order to do that, you have to understand when things are in transit, whether it belongs to the company or not, right? If things are consigned, does it belong to the company or not? What kinds of costs should go in, right? Does freight in, remember the shipping costs, does that go into the cost of the inventory? Or, are there other costs that we don't know about? So product costs, that's what they call it, versus period costs. We're not going to put someone's salary into the cost of inventory, but we might put certain other types of costs in there. Like if we manufacture the inventory, we might put, the people who are actually working on the inventory by the hour or something, some portion of direct labor could go onto the cost of the inventory. Then the last piece here is what I was talking about before, but we won't get to that today. Which cost flow assumption will we use? Will we use FIFO, LIFO, average cost, dollar value LIFO, some other retail method to actually, make an assumption about the cost of the inventory? So that's the next phase of our work together here. So the physical units included in inventory, right? Obviously, you just saw when a company buys inventory, whether it's periodic or perpetual, some journal entry is being made, right? Generally, when they receive the goods, they're going to debit inventory or debit purchases. But again, some challenges could arise if this is happening close to the end of the year. And remember, as accountants, we create these artificial month, it's month end, year end, and so on. It doesn't mean that the business stops at that point and everything stops and we can just do our calculations. The business still continues, trucks are still on the road and so on, but we have to calculate at December 31st, for instance, what did the company own? And we could be talking about hundreds of thousands of dollars or even millions of dollars worth of inventory that we want to make sure we are recording correctly. So the first thing that we look at is goods in transit. In transit means it's traveling somewhere, right? So they say at the end of a reporting period, this is a fancy way of saying at the end of the month or the quarter or the year, it's important to ensure proper inventory cutoff. Again, a very fancy way of saying, make sure that you are only including in the inventory the things that belong to the company, that, you know, you're not mixing things up. So you have to determine ownership of the goods in transit between, there's only two parties that could own it. It's either the company owns the inventory or the customer owns the inventory. That's it, right? So, well, I mean, on that side of the transaction, excuse me. And then there's obviously also the company and the supplier. So when we're selling stuff, it either still belongs to us or it already belongs to the customer when it's in transit. When we're buying stuff, it either belongs to us or it still belongs to the supplier. But all of this, you know, is determined by when legal title passes, you know, legal title to the goods passes. Fancy way of saying ownership rules, right? What is the rule to tell us when ownership passes from one party to the other? And if we don't get this right, we will either overstate, meaning our inventory is too high, or understate, meaning the inventory is too low, right? Understate the inventory. And if the number that we over or understate by is material, meaning it is so large that it would cause people to change the decisions they make around our financials. Like, for instance, a bank might decide not to finance us or to finance us based on the numbers that they see. And this inventory error could actually cause that number to change materially. Then guess what? If you're a public company, you have to go back and redo the work, get the auditors to look at it again, and then issue corrections on your numbers, which I'm sure you can imagine not only is a big pain to do, it's expensive because you have to pay all the auditors and people to do this stuff again. Plus, people lose faith if you make a lot of mistakes and stuff, because people are investing in the stock market and people want to loan you money and so on, are trusting that the numbers that you are putting in the financial statements are, you know, for the most part, as accurate as possible. So when we're doing this work, you know, think about, it's not just like writing in a textbook like, oh, you know, okay, FOB, this, blah, blah, blah. Think about what it actually means, the implications in real life. I'll tell you that when I was working at Deloitte, this was some years back, Deloitte here in New York, we went for, I think it was a 1 week training as managers, as audit managers, just on the different types of fraud and errors that could occur with inventory ownership. And it was, you know, FOB, shipping point, destination, all kinds of stuff that we had to go through. And that tells you that this is something that companies, you know, take very seriously. So what does this all mean for you? You have to know when you are given a question and it tells you, you know, certain circumstances around the shipping of the inventory, you have to be able to know the rules to say that the inventory either belongs to the company, or it belongs to the customer, or it belongs to the supplier. All right. So that might mean that you have to memorize the rules, or you have to do enough examples to be able to just apply them automatically. But you have to get there. It's not intuitive. It's not like you're just going to be able to remember them. Maybe you remember them from accounting one, I don't know. So the way we figure this out is we have two types of shipping conditions. The inventory can either be shipped FOB, shipping point, or FOB, destination. Okay. And when we say shipping point, this is not necessarily obviously the things are actually going on an actual ship. We're just saying that, like a FedEx drop-off point. Have you ever returned an Amazon, right? You've returned an Amazon package to a UPS store or whatever store that you've returned it to. That's a shipping point, because from that point, it's going to be loaded onto a truck or whatever, and it's going to go back to whomever. If you're buying something from Amazon, their warehouse where they load the things onto the trucks to be delivered, that's also a shipping point. But the terms of the sale will tell you whether the items are being shipped, and it's called free on board shipping point, or destination means the final destination, wherever it has been shipped to. So if it's your house, and it's FOB destination and it's coming from a supplier to you, then your house is the destination. So what are the rules? Ownership passes from the seller to the buyer when the seller delivers the goods to the common carrier shipping point. That's for FOB shipping point. So let's imagine that I buy something from Amazon and it's FOB shipping point. As soon as Amazon loads it onto one of their trucks, that item now belongs to me. All right, if I bought it FOB shipping point. And so if I'm doing my inventory, even though I don't have the item in my possession, I still have to include it in my inventory. All right, so I'll repeat. Let's even do CVS, right? CVS buys some baby formula from Enfamil and it's purchased FOB shipping point. When Enfamil puts the formula onto the delivery van, that formula no longer belongs to Enfamil, it now belongs to CVS. So when we are doing an inventory count at CVS at the end of the year, and that formula is still traveling somewhere on the Van Wyck Expressway, we have to make sure that we include the formula in the inventory balance for CVS, because if we don't, we are understating CVS's inventory, even though the inventory is not physically at the CVS location. So the buyer, in my example, CVS, owns these goods while they are in transit and is responsible for shipping costs and transit insurance. So you should be asking, well, how do you know, right? What if you're at CVS and you're doing an inventory count and that formula is not there, multiple pallets of formula? How would you know? This is part of doing the inventory count, is seeing all the purchase orders of things that have not yet been received and checking to see what the shipping terms are, to determine whether they should be included in the count or not. This is also a prime example of how someone can commit fraud. And in fact, this is exactly what happened with a client of Deloitte. It wasn't my client, but this is part of why we had to go on this training, because what the client did was white out, white out, like you erase the shipping terms. They changed it from FOB destination to FOB shipping point on all their purchases so that their inventory balance would be much higher than it was supposed to be, because inventory is an asset. So they wanted their asset balance to be higher. I guess they might have had loans and stuff, and their balance sheet had to look a certain way in order for the loans not to be called in. Okay, so it's possible that there can be fraud fairly easily by just changing an invoice from FOB destination to FOB shipping point. So not only do we as accountants need to know what FOB shipping point means, we also have to be sure that when we inspect these documents that there isn't anything that looks suspicious or, like somebody changed something. So again, FOB shipping point, as soon as the items reach the loading dock, which is also referred to as the shipping point, they no longer belong to the seller, they now belong to the buyer. Any questions on FOB shipping point?
Good, Professor.
Okay, FOB destination, now you can just imagine it's the opposite. Ownership passes from the seller to the, not the opposite, but it's basically not, the shipping point's not involved. You only own the stuff when it actually reaches you. Okay, so if we think about CVS again, they buy this formula from Enfamil. The formula is sold FOB destination. It goes onto the shipping or onto the truck. While the formula is on the truck, it still belongs to Enfamil. It will only belong to CVS when it gets to the CVS warehouse. So the seller owns the item or the inventory while it is in transit and until it reaches the destination. Okay. So when it's FOB destination, the seller owns it in transit. When it's FOB shipping point, the buyer owns it in transit. That's your shortcut. FOB shipping point, the buyer owns it in transit. FOB destination, the seller owns it in transit. Okay, and we'll do examples. And then goods on consignment is, you know, when you basically send something to someone and say, hey, could you please try to sell this for me? This a classic example that you might stay in your mind is like a wedding dress, you know, a wedding dress, a dress that is loved for just one day. And then maybe the person's like, okay, this thing is taking up space or whatever. I'm not maybe feeling as sentimental as I was. I need some money. And so they give it to a store and say, please try to sell this. But because it's such a unique item, the stores may be like, well, you know, we will keep it in the store, we'll display it. If we sell it, you can get, you know, let's say 40%, we'll keep 60% of the price or whatever split, but we'll only keep it here for like 2 months. If it doesn't sell after 2 months, you got to take it back. So the risk still lies with the owner of the dress, because if the item doesn't get sold, they got to get the inventory back, right? They got to take it back. So what does that mean for us if we're doing an inventory count? The goods on consignment remain the property of the consignor. So this is all funny words, consignor and consignee. Consignor is the person who owns the wedding dress, right? That's the one who basically gave the dress to the consignee, the store, to try to sell. And so all we're saying is, if I'm giving you something to sell on my behalf, and we have an agreement that it's going to come back to me if you don't sell it, which is what a consignment agreement is, that's still my inventory. All right, it's not yours. You can't include it in your inventory count. It's mine, and I have to include it in my inventory count. So the consignee makes no entry in their inventory for goods received. They will only make a journal entry if there's an actual sale to record whatever, you know, percentage of the price they get, and so on. So if you know, if CVS, I'm just making up stuff now. If CVS sends you know, some Tylenol to Target to sell on their behalf, and Target keeps it on their shelves, CVS will still, so it's like a CVS brand Tylenol, CVS will still have to include whatever is on Target's shelves at the end of the year in their inventory balance, even though that inventory is not physically present at the CVS warehouse or in the CVS stores. And then the other thing that it doesn't come up as much for us in our work, but I'll just mention it, is that if there's a right to a return, sellers are supposed to estimate the anticipated amount of returns and offset that against their revenue so that they don't overstate their revenue. And part of the reason that this is the case is back in the day, companies used to do a fraud scheme called channel stuffing. Very strange word, but basically what they're doing is at the end of the year, if they see that they're not going to make their sales targets, then they contact all their customers and tell them, just buy, you know, like $100,000 worth of items of inventory, and you by December 31st, and you can return it immediately in the new year. So what does that do for the company? By making those sales, they can push up their sales balance, which means people get bonuses and whatever. And the customer doesn't really lose anything because they just give all the stuff back in the new year and they don't have to pay for anything. I hope you understand. I mean, I'm not trying to give you ideas for fraud scheme, right? But that's, so now you can see why the FASB comes around and says, hey, whoa, you know, people are stuffing the channel, meaning they're selling things that really is just going to come right back in the same channel. So when a company sells stuff, they actually have to anticipate how much of that stuff is going to be returned, and they're not allowed to record the revenue for those returns. They also should increase their inventory for the amount of returns and decrease their cost of goods sold. So these companies that were busy with their fraud schemes, basically, you know, their channel stuffing sales, like they have to estimate then that 100% of the stuff is going to be returned. So they had to stop the channel stuffing fraud scheme immediately because of the change in the accounting rules. All right. So who does the stuff belong to? This is all about that, right? When we're selling inventory, who does it actually belong to? Well, if we know that it's going to be returned, we have to increase, or we can estimate how much is going to be returned. We have to increase our inventory for that number of returns, which then impacts our ending inventory number as well. And then over here, I'll just, you know, remind you, I said this earlier, but I'm not sure that, you know, that it necessarily would have stuck, and it bears repeating that the cost of inventory includes all the necessary being an important word, expenditures to bring it to its desired condition and location for sale or use in the manufacturing process. So you are allowed to include insurance, insurance costs during transit, not insurance, you know, of your building or something. You're allowed to include any transportation costs or freight costs if there's a cost of unloading or unpacking, preparing it for sale, you know, preparing the raw materials for use. These are all part of the product costs of the inventory, the inventory product, they all count. And if these costs are so immaterial that you really can't trace them, you know, like some of the unpacking and unloading is very difficult to say how much of someone's pay relates specifically to unpacking a truck, then you don't have to go so deep to figure it out. That's what they're saying. But you can include all the necessary expenditures to bring it to its desired condition and location for sale. That's what I was talking about when I said that sometimes in the supermarket, the prices go up when gas prices go up as well. And here's some examples of how we would record, you know, in a journal entry, which we're not required to do here at the moment, but how you would record the freight in, you know, in perpetual, you put it in the inventory account. In periodic, there's a freight in account. So we're almost at time. What I will say is that the next thing that we'll do when we come together on Wednesday is we will work through an example where a company is doing an inventory count at the end of the year. They've counted what is on hand, meaning, you know, in your hand, in the warehouse and in the store. And then they basically have these, I don't know if it's 5 or 6, 5 different items of inventory that they're not sure if they should be included because all were excluded from the count. And so then we will go through based on the rules of Fob Destination and Fob Shipping Point, and also the rules of consignment to see whether this $441,000 price is, not price, cost is actually correct. And what I will do later, maybe today, because I know some people are working ahead and that's great, is that I will put under the notes and examples, I'll put the solutions, all right, for the work, so that if you feel like you want to be tackling the homework, but you aren't sure if you are following the proper procedure, then at least you don't have to wait until Wednesday and then wait until the following Monday and so on to see how I'm working through the calculations. Would that be helpful, or do you guys want to wait and see what the answer is until I calculate it? But you want the answers, or you don't want the answers?
I want answers.
You want answers. Okay. We have one person. You've now allowed one person to speak on behalf of the whole class. So that's fine. I'll put up the solutions. I encourage you to try if you want to work ahead, right? But try the questions yourself first and then compare your answer to my answer. Does this then mean that you should not attend the class? Absolutely not. I'm taking attendance. There's still benefit in you being here, thinking about things as we go through them, asking me questions, hearing questions other people are asking. And remember, if you just stop attending, I have to change your status in the system as, that WU or something. So please don't, I know you guys know the throw, but I just have to be sure to say this. I'm not putting the answers up as a substitute for being present in the class. That's absolutely not what this is about. So a few people have already emailed me about which company they want to do. There's there's already 2 or 3 people are doing Netflix, so please, you don't have to email me on Wednesday. You can email me before Wednesday. It's supposed to be by Wednesday. Tell me which company. Are you asking if I posted the recording on Blackboard? No, the recordings are posted on YouTube. The recordings for this class are posted on YouTube, and I can show you. Yeah, so that's, don't worry, Pura, I got you. Let me stop the recording so I can just show you, or maybe it's helpful to people, I guess, in the recording. So let me see if what I did here for the recording. Hang on 1 second, guys. Oh, I don't have it for you guys. Okay. So I will, let me think of what's best. I'll put the